Are you looking to borrow money but feeling overwhelmed by the countless interest rates you come across? You're not alone. Navigating interest rate comparisons can be a daunting task for many borrowers. But fear not, because in this video, we will guide you through the process of smart borrowing and help you understand how to find the best interest rates. Understanding interest rates. Interest rates play a crucial role in determining the cost of borrowing. They represent the percentage of the loan amount that lenders charge as compensation for lending you the money. Understanding how interest rates work is the first step towards smart borrowing. When you borrow money, the lender assumes a certain level of risk. Interest rates are determined based on this risk, as well as other factors such as the loan term and the type of loan. Generally, loans with higher risks will have higher interest rates to compensate for the lender's potential losses. On the other hand, loans with lower risks will have lower interest rates. The importance of comparing interest rates. Comparing interest rates is essential to ensure that you are getting the most favorable terms available. Even a slight difference in interest rates can have a significant impact on the total amount you will ultimately pay. Let's consider an example. Suppose you're looking to borrow $20,000 for a personal loan with a term of 5 years. Lender A offers an interest rate of 8%, while Lender B offers an interest rate of 10%. At first glance, the 2% difference may not seem significant. However, when you calculate the total interest paid over the loan term, the difference becomes clear. With Lender A, you would pay a total of $4,537.16 in interest, whereas with Lender B, you would pay $5,929.48. That's a difference of $1,392.32. By comparing interest rates, you can save a substantial amount of money over the long term. It's worth investing the time and effort to find the best interest rates available. Factors to consider when comparing interest rates. When comparing interest rates, several factors should be taken into consideration. It's not just about finding the lowest rate. You also need to evaluate the overall terms and conditions of the loan. Here are some key factors to keep in mind. Loan term. The length of time you have to repay the loan can affect the interest rate. In general, shorter loan terms tend to have lower interest rates, while longer loan terms may have higher rates. Loan type. Different loan types may come with different interest rates. For example, personal loans typically have higher interest rates compared to secured loans, such as home equity loans, which have collateral backing them. Credit score. Your credit score plays a significant role in determining the interest rate you will be offered. Lenders view borrowers with higher credit scores as less risky, and therefore, they may be eligible for lower interest rates. Lender reputation. It's important to consider the reputation and reliability of the lender. Research their track record, customer reviews, and any complaints filed against them. A reputable lender is more likely to offer competitive interest rates and provide better customer service. Additional fees. Interest rates are not the only cost associated with borrowing. Be sure to consider any additional fees, such as origination fees or prepayment penalties, which can impact the overall cost of the loan. Taking these factors into account will help you make a more informed decision when comparing interest rates. Where to find interest rate comparisons? Now that you understand the importance of comparing interest rates, you may be wondering where to find reliable sources for these comparisons. Here are some places to start your search. Online comparison websites. There are various websites dedicated to comparing interest rates across different lenders and loan types. These platforms allow you to input your loan requirements and provide you with a list of lenders offering competitive rates. Some popular comparison websites include Bankrate, LendingTree, and NerdWallet. Financial institutions. Many banks and credit unions provide information on their website about the interest rates they offer. You can visit their websites or contact their customer service representatives to gather this information. Independent financial advisors. If you prefer personalized assistance, you can consult with an independent financial advisor who can help you navigate the world of interest rates and provide tailored recommendations based on your specific financial situation. Government resources. Government agencies, such as the Consumer Financial Protection Bureau, CFPB, in the United States, often provide resources and tools to help borrowers compare interest rates and understand their rights as consumers. These resources can be valuable in your search for competitive rates. Remember, it's essential to use multiple sources and compare rates from different lenders to ensure you are getting the most accurate and up-to-date information. How to use interest rate comparison tools effectively. Interest rate comparison tools can be powerful resources in your quest for the best rates. However, it's important to use them effectively to make the most informed decisions. Here are some tips for using interest rate comparison tools effectively. Input accurate information. To receive accurate rate comparisons, make sure to input your loan requirements accurately. Provide correct details about the loan amount, loan term, and your credit score. Even slight variations in the input can lead to different rate results. Compare multiple lenders. Don't settle for the first lender you come across. Take the time to compare rates from multiple lenders. This will give you a better understanding of the range of interest rates available and help you identify the most competitive options. Consider overall loan terms. While interest rates are crucial, don't forget to consider other loan terms as well. Evaluate factors such as repayment flexibility, prepayment penalties, and customer service. The lowest rate may not always equate to the best overall loan package. Read customer reviews. Before finalizing your decision, read customer reviews and feedback about the lenders you are considering. This can give you insights into the experiences of previous borrowers and help you gauge the lender's reputation and customer service quality. By following these tips, you can use interest rate comparison tools effectively and make well-informed borrowing decisions. Common pitfalls to avoid when comparing interest rates. While comparing interest rates is crucial, it's important to be aware of common pitfalls that borrowers often fall into. Avoiding these pitfalls will help you navigate the interest rate comparison process more effectively. Here are some pitfalls to watch out for. Focusing solely on interest rates. While interest rates are important, they should not be the only factor influencing your decision. Consider the overall loan terms, fees, and customer service quality to assess the true value of the loan. Ignoring additional costs. Interest rates are not the only cost associated with borrowing. Be sure to consider additional fees, such as origination fees or closing costs, which can significantly impact the total cost of the loan. Not comparing different loan types. Don't limit yourself to a single loan type. Explore different options, such as personal loans, lines of credit, or credit cards, to see which one offers the most competitive interest rates for your specific needs. Neglecting your credit score. Your credit score plays a significant role in the interest rates you are offered. Take steps to improve your credit score before applying for a loan to increase your chances of securing lower rates. Rushing the decision. Take your time when comparing interest rates. Rushing into a decision without careful consideration can lead to regret later on. Thoroughly evaluate your options and choose the loan that best meets your needs. By avoiding these common pitfalls, you can ensure that you are making informed and confident borrowing decisions. Tips for negotiating a lower interest rate. While interest rates are determined by various factors, there is often room for negotiation. Here are some tips to help you negotiate a lower interest rate. Improve your credit score. A higher credit score can make you a more attractive borrower in the eyes of lenders. Before applying for a loan, take steps to improve your credit score, such as paying off outstanding debts and ensuring timely payments on existing credit accounts. Shop around. Don't settle for the first offer you receive. Shop around and compare rates from multiple lenders. Armed with competing offers, you can negotiate with lenders to match or beat the rates offered by their competitors. Highlight your financial stability. Lenders prefer borrowers who demonstrate financial stability. Provide evidence of a steady income, a low debt-to-income ratio, and a strong employment history. This can increase your chances of negotiating a lower interest rate. Leverage existing relationships. If you have an established relationship with a bank or credit union, use it to your advantage. Existing customers often have access to better rates and may have more flexibility in negotiating. Remember, negotiating a lower interest rate is not guaranteed, but it's always worth a try. The worst that can happen is that the lender says no, but you may end up securing a better deal than initially offered. The impact of interest rates on borrowing decisions. Interest rates have a significant impact on borrowing decisions. Higher interest rates can make borrowing more expensive, while lower interest rates can save you money in the long run. Understanding this impact is crucial when making financial decisions. Here are some ways interest rates can influence your borrowing choices. Affordability. Higher interest rates can increase the monthly payments on loans, making them less affordable. When interest rates are high, you may need to adjust your budget or consider borrowing a smaller amount to make the monthly payments manageable. Opportunity cost. Lower interest rates can provide an opportunity to borrow more money without significantly increasing your monthly payments. This can be beneficial if you have financial goals, such as home improvements or investments, that require additional funds. Refinancing opportunities. When interest rates drop significantly, it may be advantageous to refinance existing loans. Refinancing allows you to replace your current loan with a new one at a lower interest rate, potentially reducing your monthly payments or shortening the loan term. Debt repayment strategies. Interest rates can impact how you prioritize your debt repayments. If you have multiple loans, focusing on paying off the loans with the highest interest rates first can save you money and interest charges over time. Considering the impact of interest rates on your borrowing decisions will help you make choices that align with your financial goals and circumstances. Case studies. Real-life examples of interest rate comparisons. To illustrate the importance of interest rate comparisons, let's look at a couple of real-life examples. Case study 1. Mortgage comparison. John is looking to buy a house and needs a mortgage loan of $300,000. He is considering two lenders. Bank X, which offers an interest rate of 4.5%, and Bank Y, which offers an interest rate of 5%. The loan term is 30 years. Using an online mortgage calculator, John calculates that with Bank X, his monthly mortgage payment would be $1,520.06, and he would pay a total of $247,217.60 in interest over the loan term. With Bank Y, his monthly payment would be $1,610.46, and he would pay a total of $279,767.60 in interest. By choosing Bank X over Bank Y, John would save a significant amount of money in interest payments over the life of the loan. Case study 2. Personal loan comparison. Sarah is planning a home renovation project and needs a personal loan of $20,000. She is considering two lenders. Lender A, which offers an interest rate of 10%, and Lender B, which offers an interest rate of 12%. The loan term is 5 years. Using an online loan calculator, Sarah determines that with Lender A, her monthly payment would be $424.94, and she would pay a total of $5,496.40 in interest. With Lender B, her monthly payment would be $445.26, and she would pay a total of $6,715.60 in interest. By choosing Lender A over Lender B, Sarah would save approximately $1,219.20 in interest over the loan term. These case studies demonstrate the significant impact that interest rate comparisons can have on the total cost of borrowing. Conclusion. Making smart borrowing decisions. Navigating interest rate comparisons can be overwhelming, but with the knowledge and tools gained from this video, you are now equipped to become a smart borrower. By understanding how interest rates work, comparing rates effectively, and considering various factors, you can make informed borrowing decisions that save you money in the long run. Remember to take your time, explore multiple options, and negotiate when possible. Interest rates are not set in stone, and there is often room to secure a better deal. By being proactive and diligent in your approach to interest rate comparison, you can find the best rates available and make borrowing a more affordable and rewarding experience. So, go ahead and make the most of your borrowing journey with smart interest rate comparison.